Welcome to my channel. Please like, comment, and subscribe. The key elements of an insurance contract. Buying insurance usually form the backbone of anyone's financial plan, offering some reassurance of financial stability should the worst happen. Life insurance, health insurance, automobile insurance, home and or renter insurance are all necessary facts of life for most people. Any type of insurance is purchased by contract, where the rights and responsibility of both the insured and the insurance company are clearly outlined. Here we will examine all of the components in an insurance contract that make it a legally binding document for both parties. The first is offer and acceptance. When a prospective insured goes to buy an insurance policy, they must fill out an application provided by the insurance company. If they are shopping online, they will complete a digital application. If they are working with an agent or broker, then he or she may fill out for the customer. The application is legally known as offer. When the insured offer to make a premium payments for a certain dollars amount in return for insurance coverage up to specific limits, acceptance occurs when the insurance company formally issues the policy or when the agent or broker issues a certificate of temporary coverage. The next is legal consideration. This represents the dollar value of the premium that the insured agrees to pay and the dollar limit of the coverage that the insurer will provide in return. If the insurance company receives a claim that is covered in the policy, then the insurer will pay this claim. The next is competent parties. Insurance contracts are only valid if both parties are of sound mind and body, referred to legally as competent parties. The insured must be at least the legal age of majority and the insurance company must be licensed in state in which the insured lives. Next is legal purpose. All insurance contracts are required to obey the law of the land. They must adhere to all state-specific laws that apply to the contract and cover only legal activities. A business that deals in criminal activity would not be covered according to the tenet of the legal purpose. Any agreement that is made outside of those laws is null and void. The next is insurable interest. The insured has an insurable interest when they benefit financially from the person or thing being insured. The insured will then experience a financial loss if the item or person being insured either dies or is damaged or lost. Prospective insured cannot get coverage on something in which they have no insurance interest. The next is utmost good faith. This phrase, utmost good faith, means that both parties in any insurance contract have acted without any type of deception, omission, or other form of misrepresentation, and that all pertinent facts have been disclosed by both parties. The next is material facts. Material facts are the factors that affect the risk that is being taken. They consist of the factors that the insurance company needs to know about in order to decide whether to insure the risk or reject it. If an insurer applies for life insurance, then the insurer will need to know all about the insured, like the age, the height, the weight, the health, occupation. For car insurance, the insurer needs to know the insured age, driving record, the kind of the car that is being insured. The next is full and true disclosure. This means that both parties are required to completely disclose all the material facts pertinent to the insurance policy. There can be no omission, mispresentation, or twisting of the facts when filling out the application or providing the policy. The next is duty of both the parties. Duty of both parties. Both the insurance and the insurer have a legal obligation or a duty to disclose all material facts accurately and correctly. The insurer does this when they fill out the application, and the insurance company does this by adhering to all of the laws and rules that apply to it. And then the next is principle of indemnity. The principle of indemnity applies to most types of insurance policies. It means that the insurance company will compensate the insured with a cash settlement and a covered loss occurs. The idea is that the insurer will be in the same position financially that they were in before the loss occurred. And then the next is conversely, the insured cannot receive greater compensation than the amount of the loss. The insurance company is only required to cover the actual monetary value of the loss and no more. And then the next is doctrine of subrogation. Subrogation allows the insurer to pursue reimbursement from a third party that caused the coverage insurance loss. For example, if another driver crashes into the insured car and total it, then the insurance company will repay the insurer of the loss and then pursue reimbursement for the other driver insurance company. I think that's all the explanation that I can share to you about the important terms of insurance contract. I hope it can help you. Don't forget to give like, comment, and subscribe.